Have you ever wondered who decides how much money is in your pocket? Or who makes sure the banks where your parents keep their savings are safe? The answer to these big questions lies with a very important institution called the Reserve Bank of India, or RBI. Think of the RBI as the captain of a giant ship, and that ship is India's entire economy. It is the country's central bank, which means it is the main authority that manages all things related to money, banking, and finance. It is the boss of all other banks and the guardian of our nation's wealth, working silently behind the scenes to keep our economic life stable and running smoothly every single day. The RBI is not just any ordinary bank where you can open an account. It is a special bank with very special powers and responsibilities. Its main job is to ensure that the Indian rupee, our currency, remains strong and valuable. It also works to make sure that there is enough money available for people to buy things and for businesses to grow, but not so much that prices start rising too fast. This delicate balancing act is crucial for everyone, from a small farmer in a village to a large factory owner in a city. The RBI's decisions affect the interest you pay on loans and the returns you get on your savings, making it a powerful force in our daily lives. Imagine a country without a central bank. It would be like a busy city intersection with no traffic lights. Cars, or in this case, banks and money, would move around without any rules, leading to chaos, accidents, and a complete breakdown of the system. The RBI acts as those traffic lights, creating rules and signals for the entire financial system to follow. It ensures that money flows to the right places at the right time, preventing economic jams and crashes. This helps build trust in our banking system and our currency, which is the foundation of a healthy and growing economy for a large country like India. So, in simple terms, the RBI is India's ultimate money manager. It is the institution that prints our colorful banknotes, manages the country's savings in foreign currencies, advises the government on big economic decisions, and keeps a watchful eye on all the banks. From the crisp new notes you get from an ATM to the stability of the prices at your local shop, the hand of the RBI is always there, guiding and protecting. Understanding what the RBI does is like learning the secret rules of how money works in our country, and it helps us appreciate the complex machinery that keeps India's economy moving forward. The story of the Reserve Bank of India begins long before India gained its independence. In the early 20th century, the financial system in India was quite messy. There were many different banks, but there was no single leader or regulator to control them. This led to frequent bank failures, and people often lost their hard-earned money. The British government, which ruled India at the time, realized that a strong central banking institution was needed to bring order and stability. The idea gained strength after a group called the Hilton Young Commission officially recommended the creation of a central bank for India in 1926. Following these recommendations, the Indian government passed the Reserve Bank of India Act in 1934. This law laid down the foundation and the rules for the new central bank. Finally, on April 1, 1935, the Reserve Bank of India started its operations. Its first office was in Calcutta, now Kolkata, but it was permanently moved to Bombay, now Mumbai, in 1937. Initially, the RBI was a privately owned bank, meaning its shares were held by private individuals. Its primary role was to regulate the issuance of banknotes and to maintain monetary stability in the country, tasks that were vital for a more organized economy. A very important moment in the RBI's history came after India became an independent nation in 1947. The new government of India felt that for the country to grow and develop, the central bank should be under state control. This would ensure that its policies were aligned with the nation's goals of reducing poverty and building a strong economy. Therefore, in 1949, the RBI was nationalized. This means the government bought all its shares and became its full owner. This was a massive step that transformed the RBI from just a monetary regulator to a key partner in India's journey of nation building. Since its nationalization, the RBI has played a central role in shaping India's economic destiny. It helped in planning the country's financial path through the 5-year plans, supported the growth of agriculture and industry, and managed the economy through various challenges, including wars, droughts, and global economic crises. The journey of the RBI from a private entity under British rule to a powerful, publicly owned institution is a reflection of India's own journey. It has continuously evolved to meet the changing needs of a dynamic and growing nation, becoming the strong financial backbone it is today. One of the most visible and well-known jobs of the Reserve Bank of India is to issue our country's currency. Every single banknote you see, from the small 10 rupee note to the purple 2000 rupee note, is issued by the RBI. This gives it the exclusive right to be the sole provider of paper money in India. This is a very important power because it allows the RBI to control the amount of money circulating in the economy. It decides how many new notes need to be printed and put into circulation to meet the demands of a growing population and a growing economy. This function is vital for the smooth running of our daily transactions. While the RBI has the authority to issue banknotes, it's interesting to know that it doesn't actually print them itself. The printing is done at 4 special high-security presses owned by the Government of India. These presses are located in Nashik in Maharashtra, Dewas in Madhya Pradesh, Mysuru in Karnataka, and Salboni in West Bengal. The RBI works closely with these presses, placing orders for the exact number of notes of each denomination it needs. It also has the responsibility of designing the notes, including their security features like the watermark and security thread, to prevent people from making fake currency. The story is a little different for coins. All coins, like the 1, 2, 5 and 10 rupee coins, are minted or made by the Government of India. The RBI does not mint coins, but it plays the crucial role of putting them into circulation on behalf of the government. Once the coins are made at the 4 government mints in Mumbai, Kolkata, Hyderabad and Noida, they are handed over to the RBI. The RBI then distributes these coins, along with the banknotes, to the public through its network of offices and commercial banks across the country. So the RBI manages the entire supply of currency, both notes and coins. Besides issuing new currency, the RBI also has the job of removing old and worn-out notes and coins from circulation. When a banknote becomes dirty, torn or damaged, it is considered unfit for use. Banks collect these soiled notes from the public and send them to the RBI. The RBI then examines these notes and destroys them, replacing them with fresh new currency. This constant process of withdrawal and replacement ensures that the quality of currency in circulation remains high, which helps in maintaining public confidence in our money. It's a continuous cycle of creation, distribution and destruction managed carefully by the RBI. The Reserve Bank of India acts as the main banker for the Government of India and also for the various state governments. Just like you have a bank account to manage your money, the government needs a bank to handle its finances, and that bank is the RBI. The central and state governments maintain their main accounts with the RBI. When the government receives money, for example, through taxes, it gets deposited into these accounts. Similarly, when the government needs to make payments, such as paying salaries to its employees or funding development projects like building roads and schools, the money is paid out from these RBI accounts. This role as a banker to the government is much more than just maintaining accounts. The RBI also acts as a financial manager and advisor. It helps the government manage its domestic and foreign debt. When the government needs to borrow money to meet its expenses, the RBI manages the process. It issues special financial instruments called government bonds and securities, which are sold to the public, banks, and other institutions. The money raised from these sales is then given to the government. The RBI ensures this process is smooth, transparent, and done at the lowest possible cost for the government. Furthermore, the RBI provides crucial advice to the government on all important financial and economic matters. The RBI governor and other senior officials regularly meet with the finance minister and other government leaders to discuss the health of the economy. They provide insights on issues like inflation, economic growth, and managing the country's finances. This expert advice helps the government make better informed decisions and formulate policies that promote economic stability and development. The RBI's independent and expert opinion is highly valued and plays a significant role in shaping the country's economic agenda. Sometimes, the government might face a temporary shortage of money, where its expenses are more than its income at a particular moment. In such situations, the RBI can provide a short-term loan to the government to bridge the gap. This facility is called Ways and Means Advances, or WMA. It acts as an overdraft facility, ensuring that the government's essential payments are never delayed due to a temporary mismatch in cash flow. By performing these varied roles, the RBI ensures that the government's financial engine runs without any hiccups, which is essential for the smooth functioning of the entire country. Another one of the RBI's most critical responsibilities is to act as the supervisor and regulator of the entire banking system in India. It is often called the banker's bank because it does for commercial banks what commercial banks do for us, the public. All scheduled commercial banks in India, including public sector banks like the State Bank of India, private sector banks like HDFC Bank, and foreign banks operating in India, have to follow the rules and regulations laid down by the RBI. This makes the RBI the ultimate boss of the banking industry, ensuring that the system is safe, sound, and trustworthy for all citizens. The RBI has the power to issue licenses for new banks to start their operations. Before giving a license, it carefully checks if the applicants have enough capital, a solid business plan, and trustworthy promoters. It also has the power to cancel the license of any bank that does not follow the rules or whose functioning is harmful to the interests of the depositors. This gatekeeping role is crucial to prevent weak or fraudulent entities from entering the banking sector. The RBI also carries out regular inspections and audits of banks to monitor their financial health and ensure they are complying with all the regulatory guidelines. One of the key ways the RBI protects your money is by setting important rules for banks. For instance, it decides the minimum amount of money banks must keep aside as reserves, which cannot be used for lending. These are known as the cash reserve ratio, or CRR, and the statutory liquidity ratio, or SLR. These reserves act as a safety cushion, ensuring that banks always have enough funds to return to depositors even in difficult times. The RBI also sets rules for how much capital banks must maintain and how they should classify loans, especially those that are not being repaid on time, known as non-performing assets, or NPAs. The RBI also functions as the lender of last resort for banks. If a bank faces a sudden and severe shortage of funds and is unable to borrow from anyone else, it can approach the RBI for a loan as a last resort. This facility prevents bank failures and protects the stability of the entire financial system. By providing this emergency support, the RBI ensures that a problem in one bank does not spread and cause a panic across the country. Through these comprehensive regulatory and supervisory powers, the RBI works tirelessly to protect depositors' money and maintain public confidence in the Indian banking system. In today's interconnected world, countries trade with each other, and people travel and invest across borders. All these international transactions involve foreign currencies like the US dollar, the euro, or the British pound. The Reserve Bank of India has the very important job of managing India's foreign exchange reserves. These reserves are like the country's savings account in foreign currencies. They are a stockpile of foreign currency assets, gold, and other special international assets. The RBI carefully builds up and manages these reserves to ensure the country can always meet its international payment obligations. A strong stock of foreign exchange reserves is crucial for a country's economic stability. It acts as a buffer that can be used during times of crisis. For example, if there is a sudden outflow of foreign investment or a sharp increase in the price of essential imports like crude oil, these reserves can be used to make payments and prevent a major shock to the economy. A healthy level of reserves also gives confidence to international investors and credit rating agencies, making it easier and cheaper for Indian companies and the government to borrow money from abroad. The RBI's prudent management of these reserves is key to maintaining India's financial security. The RBI is also responsible for managing the exchange rate of the Indian rupee. The exchange rate is the price of our rupee in terms of another currency. For instance, how many rupees are needed to buy $1 US? This rate changes every day based on the demand and supply of the currency in the market. The RBI does not fix the exchange rate, but it often intervenes in the foreign exchange market to prevent extreme volatility. If the rupee is weakening too fast, the RBI might sell dollars from its reserves to increase their supply and support the rupee. This helps in keeping the exchange rate relatively stable, which is important for importers, exporters, and the overall economy. Furthermore, the RBI regulates all foreign exchange transactions in the country under a law called the Foreign Exchange Management Act, or FEMA. It sets the rules for how individuals and businesses can buy and sell foreign currency, send money abroad, or receive money from other countries. For example, it specifies the limits on how much foreign currency a person can carry when traveling abroad for tourism, education, or medical treatment. By regulating these transactions, the RBI ensures that foreign exchange is used for legitimate purposes and helps in preventing illegal activities, thereby safeguarding the nation's precious foreign currency resources. The Reserve Bank of India is a large and complex organization, and its affairs are managed by a team of experienced leaders. The highest authority at the RBI is the Central Board of Directors. This board is appointed by the Government of India and is responsible for the overall supervision and direction of the bank's work. The board's structure is defined by the RBI Act. It consists of official directors, which include the governor and up to 4 deputy governors, and non-official directors, who are nominated by the government from various fields and represent different sectors of the economy. This diverse board helps in making well-rounded policy decisions. The most powerful and visible official of the RBI is the governor. The RBI governor is the chief executive officer of the bank and is responsible for steering its policies and operations. The governor's signature appears on every Indian banknote, making it a legal promise to pay the bearer the value of the note. The governor chairs the meetings of the central board and is the public face of the RBI, communicating its policy decisions to the nation. The position of the governor is of immense importance, and their decisions have a profound impact on the entire Indian economy. They are typically appointed for a term of 3 years, which can be extended. Assisting the governor in their massive responsibilities are the deputy governors. The RBI can have a maximum of 4 deputy governors. They are also appointed by the government and are usually chosen from the ranks of senior RBI officials and commercial bankers, or are distinguished economists. Each deputy governor is in charge of specific departments within the RBI, such as monetary policy, banking regulation, or foreign exchange management. They work as a team with the governor, providing their expertise and managing the day-to-day functioning of their respective areas, ensuring that the vast machinery of the central bank works efficiently. The head office of the RBI, where the governor and deputy governors sit, is located in Mumbai, India's financial capital. However, the RBI's presence is spread across the entire country. It has a network of 31 regional offices and branches, most of which are located in state capitals. These regional offices help the RBI perform its functions at the local level, such as managing currency distribution, supervising regional banks, and conducting government business in the states. This decentralized structure allows the RBI to have a strong presence throughout India and stay connected to the economic pulse of different regions. The true importance of the Reserve Bank of India can be seen in how it responds to major economic events and challenges. Throughout its history, the RBI has taken decisive actions to steer the Indian economy through turbulent waters. A landmark moment was the economic liberalization of 1991. At that time, India was facing a severe economic crisis with very low foreign exchange reserves. The RBI played a crucial role in managing the crisis and implementing the reforms that followed. It moved from a system of heavy control to a more market-based approach, transforming the financial sector and paving the way for decades of high growth. More recently, during the global financial crisis of 2008, which caused major economies around the world to collapse, the Indian economy remained relatively stable. A large part of the credit for this resilience goes to the RBI's prudent regulations and quick actions. The RBI had ensured that Indian banks were not overexposed to risky international assets. When the crisis hit, it swiftly injected a large amount of money into the system and cut interest rates to make sure that businesses had access to credit and that economic activity did not stop. These timely interventions helped India navigate the crisis much better than many other countries. Another significant event that showcased the RBI's operational capability was the demonetization of high-value banknotes in November 2016. The government announced that the existing 501,000 rupee notes would no longer be legal tender. This massive exercise involved withdrawing 86% of the country's currency from circulation and replacing it with new notes. The RBI was at the center of this mammoth task, managing the printing and distribution of new currency across the entire nation in a very short period. While the event was challenging, it demonstrated the RBI's capacity to handle logistical operations on an unprecedented scale. The COVID-19 pandemic presented another unprecedented challenge. As the country went into lockdown and economic activity came to a standstill, the RBI stepped in with a series of bold measures to support the economy. It drastically cut interest rates to make loans cheaper, announced a moratorium on loan repayments to give relief to borrowers, and pumped huge amounts of liquidity into the financial system to ensure that credit continued to flow to businesses and individuals in need. These actions by the RBI were crucial in cushioning the economic blow of the pandemic and supporting the path to recovery, once again proving its role as the nation's ultimate economic protector. As we have seen, the Reserve Bank of India is much more than just a bank. It is the silent, powerful engine at the heart of our country's economic life. From the rupee notes in our wallets to the safety of the money we deposit in banks, the RBI's influence is everywhere. It is the guardian of our financial system, working tirelessly behind the scenes to ensure stability, growth, and trust. For a student, understanding the RBI is like getting a backstage pass to see how the Indian economy really works. It helps us understand the news, make sense of economic changes, and appreciate the complex task of managing the finances of a nation of over 1 billion people. The RBI's role as the issuer of currency means it literally puts money in our hands. Its job as the government's banker ensures that the nation's finances are managed soundly, allowing the government to fund important services like education, healthcare, and infrastructure. By regulating all other banks, the RBI acts as our protector, making sure that our savings are safe and that we can trust the banks we deal with every day. This trust is the bedrock of our entire financial system, and the RBI is its most important pillar. Without the RBI, our financial world would be a much more uncertain and risky place. Furthermore, the RBI's management of inflation and the value of the rupee directly affects our daily cost of living. When the RBI successfully keeps inflation under control, it means that prices do not rise too quickly, protecting the purchasing power of our money. Its management of foreign exchange reserves ensures that our country remains strong on the global stage and can withstand international economic shocks. These are not distant, abstract concepts. They have a real and direct impact on the financial well-being of every Indian family, influencing everything from the price of petrol to the cost of studying abroad. In conclusion, the Reserve Bank of India is an institution of immense national importance. It is the chief architect and guardian of India's monetary policy and financial stability. It touches our lives in countless ways, whether we are saving money, taking a loan, making a payment, or simply buying groceries. By ensuring that our money is valuable, our banks are safe, and our economy is stable, the RBI plays an indispensable role in India's progress and prosperity. It is truly the money boss of the nation, a silent sentinel on Mint Street, watching over the economic health of every citizen.